give a special thank you to Ken Jones of Franklin Templeton Investments. He's going to be our guest speaker for this evening. I know a few folks kind of asked, hey, anatomy of recession, didn't you guys just do that? Didn't we just cover this topic? Yes, we did. In April, we had not Dr. Ken, but we call him Dr. Jones sometimes. We had Ken on, and he walked through this very similar topic, but a lot has changed from April to where we are now here in July of 2022. And so, you know, we wanted to provide a quarterly update of the topic of where are we at with the economy right now here today, and where do we see things heading. And so Ken is going to run through just that top to bottom review of where the economy is. He's got a really, really awesome recession dashboard that we'll take a look at. And we will just kind of see a little bit of, you know, where are we heading, you know, potentially through the remainder of this year and into next year from an economic standpoint. One thing I always do like to remind is the economy and the stock market, while similar, are different. And, you know, the stock market is really a forward-looking and forward pricing mechanism. So, you know, based on where we're at with the economy right now, doesn't necessarily mean what might happen with stocks down the road. So keep that in mind as we go through things tonight. And we will try to keep things, you know, relatively high level and relatively brief. For any additional questions, definitely follow up with Marcus, follow up with me afterward as well.
And towards the end of our presentation, we'll be sure to share our contact information for those who are looking to contact us by phone, email. And just a few housekeeping things, please feel free to utilize the question and answer feature of your Zoom. We will be monitoring that question and answer box as we saw at the beginning of our introduction. And towards the end, we'll also, throughout the presentation, we may pause for questions and answers. Also, just based on time, to be respectful of your time and the busy day that you may have already had. So without further ado, we're going to pass this off to Dr. Not so much Dr. Ken Jones to provide our content for the evening.
Well, Marcus, thank you for that introduction. I am not a doctor, but I have stayed in a Holiday Inn Express recently, so I can pretend that I'm a doctor on some levels. Well, my name is Ken Jones. I've had the privilege of representing Franklin Templeton Investments now for 28 years. I've been in the industry 31 years. So, you know, with our relationship with ClearBridge, they are one of our 20 different independent asset managers, and they have this fantastic resource called this investment dashboard or recession dashboard. And it does give us a lot of insight to the markets because that is a dominant topic. In fact, you're going to see that discussion probably elevated here over the next few days. We are due to get a GDP reading on the second quarter gross national production reading. And kind of a rule of thumb has been 2 negative quarters of GDP growth constitutes a recession. And it's kind of a rule of thumb, but it's not the necessary arbitrator of a recession. We'll cover that shortly. But there is a lot of anxiety and uncertainty around the economy, and it has affected the markets. To Emmett's point, you know, markets and economies are not the same, but they are correlated. And anytime that you see elevated uncertainty, you see a lot of volatility in the stock market because it will affect the profitability of stocks. And it really is the profits that are the lifeblood of whether the markets go up in value or down in value. You can see it on an individual company basis. You know, go back several weeks ago, you had the Tele2 companies, Peloton and Zoom. One company had a negative outlook on their earnings. Peloton, as a result, saw their stock price crushed. On the other hand, Zoom is a technology that really came into its own during the pandemic. Obviously, we are still utilizing this format, and Zoom has held up and is projected to continue to grow and expand. But one of the investor pitfalls really centers around the uncertainty. And it's often been said that bull markets climb a wall of worry. And what you're looking at here on the screen, these are different bricks in that wall of worry. Probably the two biggest bricks in that wall of worry are a recession and inflation. Geopolitical events, that was kind of an unexpected curveball the markets had to digest this year. Nobody foresaw a major war on the continent of Europe, and it certainly has exacerbated some of the inflation that we've seen. So with inflation, we know we're looking at the highest inflation we've seen in 40 years. Nobody expected to see inflation at 9.1%. You have very bright minds that are in the halls of Washington, particularly at the Fed. Last year, they were saying that inflation was going to be transitory. That is a fancy word for just saying that it's going to be temporary. Obviously, the supply chain challenges post a global shutdown exacerbated inflation. The way that the Federal Reserve will address inflation is by raising interest rates. And I liken interest rates to the analogy of a gas pedal. If you want to accelerate the economy, lower interest rates. That's kind of like pushing down on the gas pedal to accelerate your engine. And by doing so, borrowing costs get more affordable. But if you want to slow the economy, let's raise interest rates, thus taking your foot off that gas pedal, and it will certainly have that effect. And that's what you're seeing now at the beginning of the year. A 30-year mortgage rate was at 3%. We're back down to 5.5%. Shoot, I think a week or two ago, we were over a 6% mortgage rate. And that certainly has slowed down a lot of the home activity. But the fear is, does the Fed raise rates too aggressively to where they stall the economy? And if they stall the economy, does it force us into recession? So there's a lot of uncertainty around that. And with these uncertainties, it causes a panic attack, and the markets will sell off. See, we've had reasons to kind of panic because you have all these uncertainties around the market, and the market will pull back. Now, when you take a look at the panic attacks, oftentimes investors do the wrong thing at the wrong time. It's often been said that the old adage was buy low, sell high. Warren Buffett, a very bright-minded individual when it comes to investing, one of the brightest minds in the investment world for the last probably 100 years. He said, I want to be buying when others are fearfully selling and sell when others are greedily buying. But from an investor standpoint, we tend to react emotionally. In fact, there's been studies that have been done on brain scans. And in fact, when you look at sitting down with either Marcus or Emmett to come up with your long-term investment goals, that is a logical process. You're planning for your long-term goals. This is the logical approach. We'll do that. The part of the brain that is activated in that exercise is the frontal lobe. Unfortunately, in periods of volatility, especially when you open your statements or we see highly negative news and market results, that part of the brain that is activated is the amygdala. And that was great for our caveman days. If we were out foraging for food and we came across a saber-toothed tiger, we knew from previous engagements with a saber-toothed tiger that was not a positive outcome. So he ran. And the same part of the brain that saved us in our caveman days lights up during these periods of volatility. And it is a painful, fearful experience, and we want to sell. And that is the exact wrong thing that we need to do as investors. And as a result, if you go back for the past 20 years, you can see that the average investor has dramatically underperformed the investments or the benchmarks we're trying to achieve because we're buying and selling at the wrong time. But when you look at, if I can get my screen to advance, when you look at the long-term success as an investor, now this is a chart that goes back to 1926. So this includes the Depression era. So this is looking at the markets over the last 96 years. What you can see is that how many times have we had a loss in the market on a calendar year of 20% or greater? It's only happened 6 times. How many times have we had a loss between 10% loss to 20%? It's happened 5 times. Then we've had 14 years where we saw losses between a 0% to negative 10%. More often than not, if you're in the market long run, you'll have a likely gain 74% of the time. The interesting observation is look how many times you've had a 20% gain in the given year, 36% of the time, which means that's about a 37% chance in any given year you can have a 20% gain. Unfortunately, markets are like the seasons. Right now we are in a very hot time of the year. Here 6 months from now, we're going to be complaining that it's too cold. Unfortunately, what you'll see for every 4 years, on average, there is a negative year. So out of every 4 seasons in a course of a cycle of a year, there's going to be 1 month when it's going to be really cold. So we do know that markets are cyclical, but when you look at those negative years, what is the common observation? Well, it was either a depression or a deep economic recession. And right now, that's where we're seeing a lot of uncertainty. And right now, the question is, can you time the market? And we look back over history, we know that time in the market is the most critical success to being a long-term investor. We also know that we're in a period of volatility, but volatility does not equal a loss unless you sell. Now, here's a chart that goes back to the early 80s. The green dot is a period in that given year that represents the year low for the market index. So at any point over the last 2.5 decades, what you'll see is that the market at any point was down on average 10%. But if you stayed in the market for that full year cycle, on average, the market had a return over 15%. So it really comes down to being a patient investor and not trying to time the market. Now, what about the economic outlook? Now, what we're looking at is there's a lot of elevated discussion right now as to whether we're in a recession. And again, you're going to see that discussion come up on Friday or on, I believe, tomorrow, where they're going to give us a reading on the GDP. It's estimated that it could be negative, although I did see a headline that they're now projecting that we could have a positive GDP number. But 2 consecutive negative real GDP quarters is commonly believed to be a recession. And it's actually the National Bureau of Economic Research that defines a recession. So I liken them to the nonpartisan referees. And they look at a number of economic activities, whether it deals with the consumer, whether it deals with the industrial production, or other aspects of the economy. And right now, we're not seeing the economic indicators point to a recession. But as Emmett said, we do have this recession dashboard, and it does give us insight to the likelihood of a recession. And what it is comprised of 12 variables that have been highly predictive of a recession. And they will use green up arrows for an expansion indicator, a yellow caution circle for a caution indicator, and a red X for a recession indicator. And then they'll give an overall signal. And right now, the overall signal is still pointing to an expansion. But as you observe these indicators on a month-by-month basis, you will notice that we are decelerating on the economy. So, for example, you can take a look, retail sales. Retail sales is now a caution indicator. We are seeing declining retail activity. We're seeing it in our stores. For example, Target and Walmart, they're saying, look, we have too much inventory. And they're looking at discounting. So it does mean that the consumer is becoming a little bit more discerning. But it also could be the fact that we have spent a lot of money on goods over the past 2 years. In fact, economic research will tell us that we spent above trend line $400 billion on goods at a time that the supply chains were broken down. So that caused inflation to be very hot in the items of goods. Wages. We know that right now there is high demand for qualified employees across the spectrum, whether it's skilled labor or more entry-level labor. Right now, wage growth is in excess of 5%. That is a recessionary indicator because employers or companies are going to have to pass that higher wage cost on to you and I. So, for example, right now, a lot of the fast food chains are having to pay their employees in excess of $15 an hour in many places just to meet the demand to supply the products and services. So the dollar menu at McDonald's may become the $3 menu. So when you take a look at the overall indicators, we are seeing a decelerating economy. For now, the overall signal is still pointing to expansion. We are anticipating that the overall signal could go to caution. Now, just because it goes to caution doesn't mean that a recession is imminent, but it means that it is possible. Right now, the one area that is holding up the overall economy still is the overall job market. Right now, the job sentiment indicator. There currently are 2 jobs open for every 1 individual that are looking for a job. We are hearing headlines, companies such as Google, Apple, along with a number of other companies that are pulling down their help wanted signs. Now, they are not letting go of the skilled labor. We haven't seen elevated layoffs yet. We know that a lot of employers want to retain their high quality employees. So if this part of the market holds up, and that is important because that is 70% of the economy is consumer spending, we think we could avert a recession. Now, you may ask, how effective has this been as far as predicting a recession? Well, this is the dashboard, and each one of those columns is a recessionary year. So go all the way back to the right-hand side on this graphic. You can see that 1969 to 1970, we had a recession, and you can see what the indicators look like. So currently, the overall indicators are still looking relatively positive compared to where the recessionary indicators look in previous years. But what exactly is driving the Fed to respond aggressively to interest rates? After all, it's just back in May when Chairman Powell came out and said, 75 basis points is off the table. They raised rates 50 basis points. Then suddenly, last month, inflation came in very hot. They raised rates 75 basis points then, or 0.75%. Just today, they came out with another 0.75%. And the market actually rallied several hundred points because it does look like the Fed is getting to the point to where they're probably going to be less aggressive on raising rates. But we won't know until we get another month or 2 of inflation data. We think inflation probably has peaked, but we don't know until the data proves it out. So we're still a lot of uncertainty until we get clear direction that inflation is coming down. But what you're looking at is that the consumer sentiment was actually showing a lot of concern about rising inflation. And that will cause us to act in a way that may not be beneficial to the economy. And that's why the Fed moved into a much more aggressive posture. So they're trying to get ahead of this inflation story. We also know that so the business sector, we know that similar to consumer confidence, businesses are showing a lot of concern about higher inflation and higher interest rates. And that could weigh on whether they hire people or whether they spend money on capital expenditures, either on equipment or other aspects to their business. So we know that we do have a crisis in confidence both at our corporations and household level. We also know that we are in a period when financial conditions are becoming much more restrictive, and that does increase the likelihood that we could have a recession. So we think that we do run the risk of tipping into a recession in the coming quarters, but there's a lot of discussion around whether we can engineer a soft landing, meaning can the Federal Reserve raise interest rates to the point where we slow inflation down, but does not tip us into a recession. But what is the case of that soft landing? Well, if you go back and take a look all the way back to the 1950s, we've seen 13 Fed tightening cycles, meaning that the Fed was raising rates. 10 of those did cause us to go into recession, meaning they raised rates too much to where they stalled the economy. 3 were soft landings, meaning that they slowed the economy down, got inflation under control, and didn't cause a recession. The last one was 1994, when Greenspan raised rates aggressively back then. So as a result, there's still a tremendous amount of uncertainty around this. And as a result, the market is going to be very volatile until we get clear direction. Now, what about the consumers? Are you and I more sensitive to interest rates? And right now, we know that household leverage is at 50-year lows, meaning that the borrowing cost may be muted as far as causing us to pay more in debt servicing. Now, what about the labor markets? Right now, if you take a look on the left-hand side, that is the number of job openings. So right now, you can see that we are in a period when there are a lot of jobs. We know that wages have been growing, but we are starting to see wages start to come back down, which is good because that will help moderate inflation. So for now, we think the job market is still holding in there. We're not seeing elevated layoffs, and we are starting to see that weekly payrolls or wage gains are starting to moderate. But really, the canary in the coal mine is really going to be, yes.
Sorry to interrupt. I just have one question here. Going back a couple of slides, when you said household leverage is at 50-year lows.
Yes.
Can you kind of explain a little bit of what you mean by that?
Yeah, so what you're looking at, that is looking at all of the outstanding debt, whether it's our mortgage, whether it's our credit cards, whether it's our student loan debt, whether it's other types of debt liabilities versus how much our net worth. So what you're looking at here is that currently, when you take a look at what's referred to as household leverage, it currently stands at 11.1%. But if you go back and you look at that line relative to the 1960s, that's when we were at a period when we had very low leverage overall. So right now, while rates are up, a lot of people were effective in refinancing their household mortgages. So unless you are forced to sell your house and refinance or to take out a new loan, even though mortgage rates are now nearly double, we are in a position where a lot of households now are sitting on very low debt.
That makes sense. And that's, obviously important because especially if folks have, large credit card bills or that sort of thing, as interest rates go up, the, payment amount is going to be, more on a monthly basis as well, right?
Yep. And we are starting to see some signs that some consumers are increasing credit card debt
Right.
as a way of bridging the gap on higher inflation. They are starting to see the price of gasoline come down. That really has to do with the overall industry being caught flat-footed as far as providing inventory. So if you go back to, say, it was March of 2020, we weren't traveling. We were in a shutdown economy. So if you were an oil company and you were drilling for oil, the price of oil fell down to below $30 a barrel. And in fact, in the month of May that year, they were actually paying people to take delivery of oil because they had too much coming out of the ground. So you saw a number of rigs that were operating shut down. So pre-COVID, we had about 800 operating rigs. In the midst of COVID, we had about 250 rigs that were left pumping oil. So we had about 500 of those rigs shut down. Then as we've reopened our economy, we're starting to travel again. So we saw a big consumption of gasoline. Inventory levels declined. And then oil companies started operating their rigs. And then the industry for travel was shut down because we weren't traveling for COVID. So the oil inventories, or I guess the jet fuel inventories, were very low. So the industry is really playing catch up, whether it's jet fuel, whether it's diesel fuel, gasoline. And as a result, we think we probably have seen peak oil, peak energy prices. We think that oil over the next 5 years will probably settle in around $80 a barrel. And right now we know that the market is adjusting. We are making progress on electric vehicles. So we'll lessen the demand for gasoline going forward. So we think that the market is adjusting on a number of fronts from a post-COVID world.
Perfect. And so with the labor market, I know you shared that amazing fact that there are 2 jobs for every job seeker out there. Do we have the numbers? What's the current unemployment rate right now?
Right now it's about 3.6%.
3.6. Perfect.
And take a look here. So I went back to this graphic here. So you can see here on the left-hand side, that is the number of U.S. job openings. So look at the Great Recession. You can see we had a large drop in employment. In fact, very elevated levels of unemployment. But if you were to kind of draw a line and say, okay, how long did it take us to get back to the pre-financial crisis job openings? It wasn't until close to 2014 before we recovered the number of jobs we had pre-financial crisis. Here, if you take a look, we had a big drop in 2020 when we were in uncharted waters. Never purposely shut our economy down, but then look at the explosion on job openings. But you had this explosion in job openings as you had a number of people leave the workforce. It's been referred to as the Great Resignation. A lot of people said, you know what, I've hit my number from a retirement standpoint. We saw great explosion in net worth. In fact, I think I have a slide coming up looking at overall net worth. So you had all these jobs that came out at a time that a lot of people left the workforce. Some voluntarily, I'm going to retire. Others were probably forced to. Either they had to stay home and help educate kids because kids were staying at home with the school shut down, or taking care of parents, aging parents that had to be taken care of. So it's created this wage increase trying to get people off the sidelines back in the workforce. But as far as the overall market, we know that we had been in a very strong bull market until this year. And we are now in a bear market. A bear market is defined as a 20% or greater pullback in the market. But if you go back to the recoveries, going back over the last number of recoveries, and I think this goes back over the last 60 years, year 3 has always been a tough year for the markets to kind of consolidate the gains. So right now the question is, does this bear market weaken? The market gains, or do we see increased market losses, or are we at or near the bottom? And I think the market's trying to search for the fact that we're probably at peak inflation, and then are we in a recession? And then is it going to be a deep recession, or is it going to be a shallow recession? We're of the camp that if we do have a recession, it's going to be mild in nature. And once they declare that we're in a recession, we're probably mostly through it, because a lot of the recession data is in rear view. So we're probably going to be out of a recession by the time they say, guess what, we have been in a recession. Now, to put the current bear market in context, again, a bear market is defined as when we lose 20% or more. So we do know that this right here is a chart going back to the 1940s. And if you're in a recession, the average length of a bear market is 17 months, and the average decline has been 39%. So far at the trough, we're down about 27%. So if we avert a recession, we're probably at or near average. We know the average duration of a bear market in a non-recessionary period has been 13 months. So right now we're about 7 months into this bear market, and we're probably at the average decline. We've already hit the lows if that's the case. And that's why just looking at whether this is going to be a recessionary period or not is worth looking at. But we also know that valuations have improved. Coming into this year, we're looking at elevated valuations. We've seen a lot of stock prices come down. There are a lot of high quality companies that are trading at very attractive valuations now going forward. And typically, bear markets are a great entry point. So what you're looking at is that you are looking at The drawdowns on the left-hand side. So the purple bar chart here is that once a bear market has occurred, you can see another kind of drawdown on the market. But once we get through that, look at the middle graphic. You can see 6 months after a recession or non-recession, you can see that the markets are anywhere from down 0.7% if you're in a recession 6 months after the bottom to up 14%. 12 months after a recession. If you're in a recession, 12 months later, the market has recovered 9.3%. If we avert a recession, those non-recessionary bear markets have seen a recovery of 17%. So essentially, patient investors typically are rewarded if you're able to sit tight through the complete cycle. Another way of looking at it, as we do know that we're in a period of interest rates going up, there's a lot of volatility around that because the uncertainty, can the Fed tip us in recession? But 6 months after the first rate hike and then 12 months after the first rate hike, you can see that across the board, all asset classes tend to recover. The other interesting observation is that we are in a midterm election year. And going back to the 1960s, you have always seen a correction. Now, a correction is when the market will lose 10%, but not more than 20%. So we do know that midterm election years have seen significant volatility as well. But once you see a recovery, on average, you'll see a 32% recovery a year later after we hit those market lows. Now, what you're looking at, another way of looking at it, is that once we get through the midterm election, the average yearly return after that midterm election year has been around 15%. Now, it's anticipated right now that the Republicans will probably take the House and or Senate. Obviously, the White House is not up for election for another 2 years. But if that were to occur, you're going to have divided government. And the markets tended very much like divided government because it forces compromise for the middle, and we tend to get more moderated policies coming out of Washington. So that's kind of priced in that the Republicans probably will gain one or both, and that tends to bode well for the markets. The other interesting indicator.
Sorry, just real quick on this. From what you're kind of going through here, Ken, and I hate to interrupt you again. It sounds to me like obviously things have kind of been, beaten up. We've kind of seen some drops in, equities. We've also seen drops in bonds. But given where we're at in the game right now, what we could see over the span of the coming months and, certainly over the coming years is, a rebound, right? And it could be a good time to add in, a good time to, if there is any cash on the sidelines, to get that invested and get it working. Like you hearken to Warren Buffett. I think the quote was, buy when others are fearfully selling, right? And now might be a good time to look at doing that, right?
Yes. And, you tee up the slide right here. So when you look at the Consumer Sentiment Index, and this is kept by the University of Michigan, right now we are actually at 70-year lows as far as our confidence on the economy. And it tends to be a fantastic contraindicator. So what you're looking at is that every one of these points on here is at the low point of the consumer confidence. And then that little dot, and then those numbers that you see before you, shows the 12-month S&P returns a year later. So going back to the 1970s, so this is going back over 50 years, average return a year later, well, once we see a bottoming of that consumer index, is 25.6%. And that's where Sir John Templeton, he said his observations of the markets, he said bull markets are born on pessimism, they grow in skepticism, they mature in optimism, and they die in euphoria. Right now, things are very, very pessimistic on the overall outlook on the market. And it's represented in this current consumer sentiment. Again, it's at 70-year lows. It's at the lowest point we've ever seen. Because going back to those bricks in the wall of worry, there's so many things to be concerned about, so many negative headlines, and we know we'll get through this. I kind of liken it to the analogy of a Rocky movie. You've seen Rocky 1, 2, 3, 4, 5. You know, Rocky always got beat up in the middle of the movie, but at the end, he came back to prevail. Right now, the markets are getting beaten up. Don't know how much longer this beating is going to take place. Today's reaction to the market is the market's trying to sense, you know, is this beating? Are we near the completion of this? Have we beaten inflation, and can we avert a recession? So right now, it does appear to be a very good entry point for an investor to look at coming into the market.
Excellent. Thank you.
Right now, we know that we are in periods of elevated inflation and rising rates. Dividend growers are a great area to look for. If you have a company that is paying a dividend or growing their dividend, I like to say you can't fake a dividend check. There has to be money in the bank to send that dividend check out. If a company is growing their dividends or paying dividends, it means they have a very solid business model. So they tend to do well during periods of inflation and interest rate hikes. Overall, from the economic summary, you know, right now we think that recession risks are elevated. Right now we are kind of handicapping a recessionary risk at 55%. Are we definite on that? No. We think that, you know, obviously there is a chance for a soft landing, meaning that can the Fed raise rates enough to squelch inflation without causing a recession? But it really is going to be data dependent. We're going to be very watchful here on inflation over the next 2 to 3 months. Once we see that inflation truly is coming down, we think that will be a good indication that the Fed will become a little bit more cautious on raising rates. I think that's one of the reasons why you saw the market rally today. Corporate profits, that's going to be another area. Often looking at you know, companies, whether they can continue to run their businesses without having to lay people off. So we are bracing for continued volatility, but we do know historically bear markets are rare. Again, they occur on average once every 4 years, but they provide incredible long-term opportunities for long-term investors. So for now, we're seeing expansion in the economy, but we do think that it is, you know, showing signs that the economy is obviously weakening, and, you know, there is risk on a recession, but it does present long-term opportunities. But it really comes down to our belief that one of the most important investments you may ever make is the investment of time with a financial advisor, because the financial advisors are there to make sure that they keep your goals focused. They're there to make sure that in times of elevated uncertainty, they're the ones losing sleep at night, so you can know that your investment goals are on track. So if you're not working with Marcus and Emmett, I strongly recommend making an appointment to sit down to see how their approach to meeting your long-term investment goals, you know, are within reach. So with that, I'll say thank you, and we can open up for any questions.
Excellent. Thank you so much, Ken. Marcus, questions that we have?
So, you know, at this point, please feel free to, again, utilize the Q&A box. We did have a few questions that have actually been answered live. You know, I had a few questions myself, you know, one of which was you did mention the economic and financial impact of a recession, and Ken, you had mentioned that it may not be as harsh. I was just curious if you have some more details or any more perspective as to what led to that thought. You know, what are you thinking that we may see from an economic recession standpoint? Would it be similar to 2008 like we saw? If so, or why not? You know, whatever you have for that.
Yeah, so when you look at the overall economy, 70% of the economy is driven by consumer spending. It's you and I having confidence that, you know, we're not going to lose our job. As a result, we'll feel confident taking that vacation or, you know, spending money at restaurants or things on our kids, for our kids. Right now, our assessment is just given the fact that a lot of companies know that high quality employees are scarce. A lot of companies are going to do what they need to do to make sure they don't lay people off. They may make other cuts. They may rescind job offerings, but we don't think you're going to see elevated layoffs.
Mm-hmm.
And thus, we don't think that the consumer is going to dramatically cut back on their spending. And we're seeing signs of that. The retail sales numbers, while it's slowing, the consumer is still in a good position. They're still spending money. We know that we're spending less money on goods now. Actually, this money we're spending right now has been transferred to travel and services. Right now, some of the hottest areas of inflation are in airfares. Well, if you think about it, we haven't had the ability of traveling for the past 3 years. There's a lot of pent-up demand, but the airline industry, their supply, so to speak, has been reduced. American Airlines, for example, they're looking at hiring 18,000 people, whether it's pilots, flight attendants, people that work in the airports, just to meet that demand. So we think that we are working through the issues of inflation there. But really it comes down to the fact that we think that for now, the labor market, which is the cornerstone of consumer spending, should hold up better than, say, 2008 when you saw massive layoffs. And so that's why we think that if we do go into recession, it's going to be a mild recession. And by the time we know that we're in it, and by the time we find out we're in it, we're probably on our way out of it.
Right. And I guess you can partner that with the leveraging. It seems like the leveraging levels from that time period to where we are today, when you mentioned that we're at 50-year lows for leveraging. I think that also adds a little bit of value to that. Yeah. And then I guess a normal question, because just seeing some of the participants here are nearing retirement, in retirement, and oftentimes the immediate knee-jerk reaction is to move everything out to the safest thing. I know you also mentioned a long-term investment horizon, but for somebody that may not have the same length of time, do you have any perspective on what someone nearing or in retirement should do with that investment portfolio that they may have? Do they still look long-term, or should their perspective change?
Yeah, long-term, it's often been said that retirees don't want to buy green bananas because they may not be around to enjoy the ripe bananas. But even in retirement, I think a lot of people discount the fact that we are living in a fantastic period of time from a health perspective. When you go back and you look over history, most people died either from famine, war, or disease. Right now, we have more people dying from obesity than we do from famine, which is actually kind of a sad commentary in some regards. So we are living in a period when, our standard of living has improved. We know that life expectancy has dramatically extended out. Right now, life expectancy is in the 80s. So I think from an investment standpoint for a retiree that is in retirement, I think now is not the time to panic. If you have a stock portfolio that is overweighted, now is not the time to sell. As we saw on one of the earlier slides, you're essentially locking in your losses at that point. I think if you're kind of panicking, I think that's where it makes sense to sit down with one of you to kind of reassess the portfolio to make sure that you can recover from this bear market. We do know that this bear market will end at some point, but also to be positioned for the next bear market. Again, it's like seasons. You go back over the last 100 years, there's been a bear market on average of every 4 years. So, we will get through this one, but, we also know that over the long run, stocks have been a great driver of return, but it needs to be balanced out with the risk that it comes with.
Excellent.
Bernice, I do see that you had questions here with these slides. Yes, Marcus and Emmett can get the slides to you.
Yep.
and they provide
Right.
great reading in the evening if you have trouble sleeping,
Yeah.
unless you enjoy economic data.
Right. I did have somebody one time say that they also make good fire starter if you print them out, but we'll just get them digitally. So if anybody else would like a copy of this slides, definitely let us know. Also, we will strive to have this webinar posted to our website, which is emmett.ceterainvestors.com. You can also visit there for previous webinars that we've hosted, including the April event on this very similar topic. So, Ken, we really appreciate your time this evening. And likewise to all of our participants today, we appreciate all of you joining in this evening. We hope you found this information valuable and useful, and that it's something that will help you as you go throughout your investment journey. And we look forward to helping you out with that. So thank you all so much.
Thank you.